Hello, welcome to another session on the subject Management of Financial Services. Today, in this session, we will complete the Unit 6, which will be on credit rating. And on this subject, which is credit rating, we will cover the meaning of credit rating. We will unlock the salient features of credit rating. We'll understand the different kinds of credit rating. What are the regulatory provisions for credit rating agencies, and we will also see who are the different types of credit rating agencies available. We will briefly go through the credit rating methodology and the different types of credit rating scales, and finally we will understand what is the benefit of a credit rating for an organization, as well as we'll also look into the issues which are arising with the credit rating agencies or credit rating services. Now, before we understand what a credit rating is, let us just take an example. Like, suppose an individual goes to a bank for a personal loan. Now, before the bank sanctions a personal loan, the bank will check the CIBIL score of that individual. A CIBIL is a rating agency. A CIBIL gives a credit score of or earmarks the credit score of every individual. So now CIBIL will give a score to that individual, and the bank, by seeing the CIBIL score, will decide what whether the individual will be provided with the personal loan, or suppose he is provided with the personal loan, then what amount of personal loan he will be provided. That means the CIBIL score, what is being given by the rating agency, and what the bank understood is the capability of the individual to repay the loan amount. Or in other words, we can say that it reflects the CIBIL score reflects the credit worthiness or the reliability of that individual to repay the loan to the bank on time. So on similar lines as that of credit score, we will go through what is the meaning of a credit rating. This is more or less similar to that of a credit score, but in case of credit score, what I was telling now, it is a numerical figure, and there is a particular benchmark. That benchmark has to be reached by an individual in order to avail different types of loans. Now, similar lines, what a credit rating is. Fintech is a credit rating agency. It is a top rated credit rating agency, reputed credit rating agency. So, fintech defines credit rating as a forward looking opinion on the relative ability of an equity or obligation to meet the financial commitments. So it is a forward looking opinion. That means the credit rating which is given by the agency is an assessment of the future. The assessment of the future, whether the securities which has been issued by the company can meet the financial commitments what they have promised. Like, suppose it is a debt instrument, that means they will be providing, the borrower will be providing interest to the lenders. So how far the borrower will be able to provide the interest to the lenders. So it is a forward looking opinion. That means it is an assessment in future, for the future, whether they will be able to meet the financial commitments or not. In the view of US Securities and Exchange Commission, they define credit rating as a credit rating reflects a rating agency's opinion, it is an organization's opinion, as a specific date of the credit worthiness of a particular company, security, or any obligations. So now the rating agencies will give a rating to the specific security. It may be a bond, it may be a debenture, or any other debt securities which are issued, or it may be the securities, any other securities which are issued by the company, or in total the rating of a particular organization to understand or to give an assessment or to get a perception how far the company will be able to repay the obligations as mentioned during the time of the issue of the securities. So it is on that specific date, on that particular date, it determines the credit worthiness of the particular company. John Moody, this is also a reputed credit rating agency, Moody. So John Moody has published the first credit rating for a US railroad bond in 1919. So it is not a recent thing. It is the concept is coming from since long. So it was first started in the year 1909. So credit rating is an opinion whether the borrower of a fixed income security can pay the full amount on time. That means the borrower of a debt security who is going to provide interest to the lenders at particular intervals. So whether that borrower will able to pay the interest as well as the principal on time to the individuals or the organizations who have lent money to the borrower. So it is an opinion or the perception. The issuer is rated on different scales rather than good or bad. So they are not telling that this company is good, this company is bad. Rather, they have different scales, rankings, based on which the issuer will assess whether this is the whether they will the issuer is the company is rated on different rating scales, and they will be ranked on different rating scales based on which the individual investor who are going to invest in the debt securities, they will assess whether they are going to invest in that company or not. So the credit rating is overall a view on the credit worthiness and is derived from how they are going to derive that particular rate, whether it is A or A plus or triple A, how they are going to derive at a particular figure. It is derived from several factors which are both objective as well as subjective factors, which will be which will be discussing later on in the slides. It tells both the ability of that individual company and willingness of that company to pay back the amount invested to the investors. So I hope everyone is clear regarding the definition of credit rating. It's just an opinion for a future assessment or for the investor to know the credit worthiness of the company who is issuing the debt securities, or the credit worthiness of that individual instrument where they are going to invest their money. Now let us discuss about some of the characteristic or salient features of credit rating. A single symbol, which is a rate, it may be A, B, C, D, or any other rates as it depends on the credit rating agencies. A single symbol represents a large amount of information on the expected loss of the debt instrument. So suppose it is B or C or D, one particular symbol, suppose it is C grade, suppose the rating is C, that means that particular symbol represents a wide range of information. That symbol gives a negative impression that yes, if I invest in that security, my expected loss will be more. My expected, there is a loss of my investment. So that is why I should go for such type of instrument which has a rating, higher rating, which is a rating of A or triple A. So that symbol is a small symbol, but it accumulates large informations which is represented by a small symbol. The rating involves now the symbol which is being derived by the rating agencies. It involves all the qualitative information, quantitative information, and as well as the legal information about the issuer. Issuer is the company or the organization who issues the debt securities. So now the rating which is derived is not only derived from one particular aspect, it is derived from qualitative informations of the company, from the quantitative informations which is publicized, as well as the legal information. So when we talk about qualitative information. That means a rating agency does a qualitative analysis of the entire organizational management. Let us, like if it is a qualitative analysis, that means the rating agency will consider who are there, who are the members in the board or the management of that company. So what is the quality of management they are having? How is that company placed among the entire industry? Suppose they are giving a rating of Infosys. Now, how is Infosys placed among the entire IT industries, positioned itself, or what is the competitiveness of Infosys among the entire IT industry? So they will assess and analyze the expected growth of that industry as a whole. If we are analyzing a particular company's competitiveness, we will also see the life cycle of that industry as a whole. What is the growth of that industry in future and its vulnerability to the regulatory changes? How far the industry as a whole is adapting to the changes made by the regulatory authorities. And it will also assess the labor relations as well as the technological changes and its adaptation to the company as well as the industry. So it is not a very small thing. They are doing an entire macro analysis and micro analysis of the company before giving a rating to a particular issuer. Similarly, beyond the qualitative analysis, the rating agencies goes for a quantitative analysis, and this quantitative analysis, the facts and figures or the statistical data they are getting from the published and unpublished financial statements of the company. And these financial statements is not only the long-term statements as well as short-term performance of the company. So they will see all the quantitative facts and figures before deriving into a rate or a particular symbol for giving a rate. Now, rating tends to be cycle neutral. The CRA, that is the credit rating agency, analyzes the factors in such a way that an expected change in short-term factors are built in the long-term analysis. It provides a stability to the ratings. So it is not that but they are not dependent on a particular short cycle for making their prediction of the rate of that particular issuer. So what a credit rating agency does, they take into account the long-term performance and short-term performance also. But when they give a picture, they make a give a particular rating, the uh, volatility or the short-term fluctuations in the performance are not taken into account, rather than the future goal or future performance prospect of the company is taken into account. So the rating overall provides a stability, provides a picture which gives the stability to the ratings. So it is not that on a short term performance basis, suppose in the first quarter the company has not performed well, so on that particular basis they will give the rating. They will analyze the entire thing and they will look at the prospect of the industry and provide a stability to the rating. Or else the rating will, if they consider these short term fluctuations or volatility, the ratings will go on changing every at short time intervals. uh, a holistic analysis of the rating makes it a robust one which is not easy to deduce from observation or can easily be contradicted. So when they are taking into account the qualitative analysis, the quantitative analysis, so they are taking the entire macro and micro uh, macro aspects, environmental aspects of the company. So it is not, it is something which is very concrete, and it is not a small thing which can be made or deducted or concluded from a particular observation, or it cannot be again easily challenged by anyone, because they have their different parameters or factors based on which they are deriving to a particular qualitative rate. So they do not change very often with short-term business dynamics or change in the economic factors. As we were just discussing, a variation in the quarterly performance of a company may not necessitate a revision in the rating. So they are not exactly giving the rating based on short-term fluctuations or volatility or disturbances in a company. There might be some temporary disturbances in the performance of a company, but that does not have an impact on the rating which they have derived, or else this rating would have been a more volatile thing. Now, credit rating may not indicate a same profitability of corporate default during the recessions and expansions. Credit rating is meant to provide a view on probable corporate default till the maturity of a instrument. So credit rating will give a assessment, or you can say the perception within the individuals who are investing in that company, that what is the probability that the company will not default till the maturity of the instrument, and they will get their principal amount back with the regular payment of interest. So that idea the investors will get by looking into the credit rating of the issuer. Some of the other salient features of credit rating are: most of the issuers prefer to rate their debt instruments with multiple CRS. Now, there are different types of credit rating agencies, what that we will be discussing later on. So, it is not that suppose one issuer is going for rating their debt instruments with one agency, it can also go for uh, rating with other agencies, so that both of them can be validated, because everyone might be having a difference in the parameters and difference in their analysis. So the issuer might prefer to rate their debt instruments with multiple credit rating agencies. Ratings provide a relative measure of default risk, but they cannot be termed as probabilities of default. So the person who is an investor, by seeing the rating, he might know that yes, the company which is having a rating of A might not default in risk. They might not default in payment. So that means here the risk of defaulting is less. But exactly we cannot term that yes, probabilities of default in payment might not be there. Yes, there is it is just a assessment or perception, but the otherwise, suppose a highly rated company may also default in future. So it is not that completely it is eliminating the fact that the company which is having a higher rating or high quality rating may not default in future. So ratings measure credit risk. That means the ratings measures the credit worthiness or the eligibility or willingness of that company to repay the principal amount within the maturity period. So they do not provide a valuation measure to the company. It is just a measure of the credit worthiness of the individual or the issuer. Although information used by credit rating and equity analysis are same, both of them are different in nature. Now, a person who is going for a equity analysis also takes the same type of information, both qualitative information and the quantitative information what we discussed. But here in case of credit rating, they focus on the downside risk. They focus on the risk elimination of the investors who are investing their money in the company. They tell that whether there is a capability or efficiency of the company in order to repay back their loans. Equity analysis, on the other hand, focuses on the upside potential of return from investment. It is equity analysis is done by the company to assess how far the investment that they have made will give them desired return in future. So this is the difference between a credit rating agency from the investor's point of view and the equity analysis from the company's point of view. So ratings are descriptive, not prescriptive of a debt situation. They are they can be, these rating agencies, the rates can be one of the factors for deciding on the investment in the debt securities by an investor. But we cannot say that it is the only parameter for decision. Now let us move on to the different kinds of credit rating. So credit ratings can be of several types. One of them is known as a sovereign rating. Now, sovereign rating means a sovereign credit rating relates to a country's credit worthiness. Yesterday, we were talking about the fundamental analysis in the last session. The fundamental analysis, when an investor invests in a company, he goes for maybe he's a long-term investment. He is into a long-term investment, not an intraday trading. So when an investor would like to invest in a company, he will definitely go for a fundamental analysis where he analyzes the economy as a whole. Indian economy, suppose he is investing in Indian company, he will analyze the economic credibility. What is the phase in which the economy of India is in? Then he will obviously analyze the industry, and then he will analyze the company in which the within that particular industry before making a investment decision. So this is one of the aspect of that economic analysis. Sovereign rating is a rating which is related to a country's credit worthiness. That means what is the credit worthiness of that particular country? That means it will reflect the company's credibility which are incorporated in that specific company. So a sovereign credit rating provides credibility to the companies incorporated in a specific country. So when it is a credit rating of an entire country, if it is US or if it is India or Denmark, so when it is a specific country, that means it is vetting or giving rating to the credibility of the different companies who are existing in that specific country. So international fund houses, foreign institutional investors prefer to invest in countries having a good rating score. So when it is foreign direct investments who come or foreign institutional investors who want to invest in India, they will definitely go for a sovereign rating. They will definitely would like to see the rating of India as a whole before taking a decision whether they are going to invest in the companies which are existing in India. Now, I would like to show a news clipping from the Economic Times, which was on January 16, 2024. Here, this is the rating of India. Fintech, as I said, it is a reputed rating agency. Fintech affirms triple B rating for India with a stable outlook amid strong growth. So this is the tagline which they have given: a stable outlook with amid strong growth. That means its growth prospects are good, and they have given a rating of triple B to India. So this is a sovereign rating. So they are rating to the entire Indian economy, and based on that, the foreign funding agencies, they will definitely see this rating before taking a decision whether they are going to invest in India or not. So the rating is supported by a robust medium term, the GDP growth forecast, and solid external finances, positioning India as one of the fastest growing nations globally in the coming years. So they have mentioned that it is going to be one of the fastest growing nations in the coming years. So it is this type of analysis beyond the rating gives a positive impact on the investors to invest in the companies in India. So this is how. Similarly, there are a few top countries which has a credit rating of triple A. In the year 2024, the top rating countries who have been rated as triple A are Australia, Canada, Denmark, Germany, Sweden, Switzerland, Norway, and Hong Kong. So these are the companies who have also been given rating as AAA. So based on that economic sovereign rating, any investor, foreign investors, they might think of investing in the companies in that particular economy. Now, another type of credit rating is known as a corporate rating. There, in case of a sovereign rating, it was the rating of an entire economy, India as a whole. But here, the corporate rating means the rating of a particular company or the instrument which the company is issuing. An eligible participant of corporate bonds should obtain the credit rating for the issuance of commercial paper for the major four from the major four credit rating agencies or any agency specified by the RBI. So any company or corporate or any industry or any corporate who are eligible to issue commercial paper they are issuing. It is a debt instrument which is a short-term debt instrument, and they are raising funds from the institutions or from the public. So now these commercial papers have to be rated. These debt securities have to be rated. These debt securities have to be rated from any of the four rating agencies as defined by RBI. A minimum credit rating, and what should be the minimum credit rating of these commercial paper? The minimum credit rating of P2 of CRISIL or such equivalent rating by other agencies is mandatory for a commercial paper which is issued in India. So they have to have a minimum credit rating of P2 of CRISIL. So this is what is corporate rating. Corporate rating is the rating of individual debt security or of a company. Now another type of rating is another type of credit rating is given to the special purpose vehicle. Now what is the special purpose vehicle? Now let us assume that a company which has issued bonds, and let us assume that the company has issued bonds worth of 1 crore, and so the bonds all the bonds have a fixed maturity period. Now within the fixed maturity period, let us assume the maturity period is 5 years. So after 5 years, the company is bound to repay back the principal amount, that is 1 crore, to the to the lenders who has purchased the bonds, to the bondholders. So now what the company does, a company prepares or makes a provision of special purpose vehicle. That means we can say this is a account where the company goes on saving for the next 5 years, so that ultimately after the 5 years the company will be in a position to repay the amount to the bondholders. So that is known as a special purpose vehicle. That means that special purpose vehicle, that account is there only existing for the repayment of the loan which is borrowed by the issue of the bonds. So now CRA, the credit rating agencies, are also rating these special purpose vehicles. So when a company is having a special purpose vehicle for a specific security debt instrument, now obviously their credit worthiness will be higher and the CRS will be giving them a good rating. So special purpose vehicles are created to provide ease in repayment to the lenders. The basic principle in creating a special purpose vehicle is to provide earmarked funds to be used for repayment of a specific loan only. So it is only for that particular debt instruments you are creating a specific purpose vehicle. Let us say, for example, a conglomerate having cement, that means a company which is having cement, steel and petroleum business. But the company may have special purpose vehicle for the cement business only, wherein the cash inflow and repayment of loan from the cement businesses are isolated in a bank account from other businesses. So some amount of cash inflow is there in that special purpose vehicle to repay the loan from that, which is aroused from that cement business. So this isolation provides comfort to the investors. SPV has fewer risks, predetermined lifetime, and cease to exist when a loan is repaid. So now SPVs are provisions which are made for a specific period of time and for a specific loan activity. So after the loan is repaid, that SPV, that account does not exist. The CRA are widely involved in rating the SPVs and plays a crucial role in defining their credit worthiness. So now CRAs are involved in rating, or they will analyze the SPVs whether they have sufficient amount which are being credited to this particular account for the future. They will analyze the entire thing, and also they play a crucial role in giving a rating to this SPV, and that increases the credit worthiness for that particular instrument. Now let us see what are the regulatory provisions of the credit rating agencies. We have understood what are the types of the credit ratings, and what are the regulatory provisions. Even the SEBI regulates the credit rating agencies. Security and Exchange Board of India Regulation 1999, amended from time to time, prescribes the legal guidelines on all matters relating to the credit rating agencies. Now, who can be declared or registered as credit rating agencies? A public financial institution, it can be any institution, a scheduled commercial bank, a foreign credit rating bank which is operating in India with the approval of RBI, a foreign credit rating agency incorporated in a financial action task force, member jurisdiction and recognized under their law, or any company or a body corporate is eligible to act as CRA. They have to be registered under the regulations of Security and Exchange Board of India. Now, the applicant who are applying for the CRA, they should have a minimum net worth of rupees 25 crores with the adequate infrastructures, and because they require infrastructure so that they will be able to provide appropriate services, on-time services to the corporates. The applicant and the promoters of the applicant have professional competence, financial soundness, and a general reputation of fairness and integrity in the business transactions. Now, all those applicants who are applying for becoming a credit rating agency, the promoters should have professional expertise in analyzing the financial parameters, as well as they should have a sense of fairness and integrity, or else the ratings will be a biased one for the investors. Now, other regulations include the promoter of the credit rating agency has a minimum shareholding of 26% in the credit rating agency. The main promoter should have this much shareholding, and every credit rating agency has to abide by the code of conduct which is prescribed in that regulation by SEBI. Every credit rating agency has to enter into a written agreement with each client whose securities is it proposed to rate. Now, suppose a credit rating agency is going to rate the security of L&T. So, credit rating agency has to undergo a MOU with L&T for that specific purpose, and every such agreement has to include the rights and liabilities of each party in respect of the rating of securities in a defined form. So in the MOU, everything with clarity should have been written. What are the information or rights to the information which a credit rating agency should have? Like, suppose if a company is not disclosing the information to the credit rating agencies, then the rating will be unfair or biased. So each and every rights and liabilities of each party will be mentioned in the MOU of both the which is entered between both the credit rating agency and the corporate client. Every credit rating agency has to, during the lifetime of security rated by it, continuously monitor the rating of such securities unless the rating is withdrawn. So every it is still the MOU. They will have the MOU for a specific period of time. So for the entire period of time, the credit rating agency has to monitor the ratings of the security for which the MOU has been made. Every rating agency has to make available to the general public information relating to the rationale of the rating, which has to cover an analysis of various factors justifying a favorable assessment as well as factors constituting a risk. Now, suppose a rating agency gives a analysis, gives a rating of triple A to a particular company, and which is there in the website of the company. So it is not only that numeric the value, alphabetical value or the rating which matters, but the rating agency are liable to give the analysis based on which they have given that particular rating. So you will see below that the rating, there will be a complete analysis of all the different type of information which they have analyzed and the rationale, the analysis, how they have framed the basic framework or analysis based on which they have given that particular rating to that company will also be mentioned or will also be open to the entire public. So that justification will also be given by the credit rating agency, not that they will only give the value, will only give the ratings, the alphabetical values to the company. Now, who are the different rating agencies? There are only 3 credit rating agencies having universal acceptance around the world. So they can operate anywhere around the world. First one is FinTech. FinTech is established in the year 1913, operating from New York, London. Next one is Moody's. This is the oldest one, and which was established in 1909, operating from New York. And S&P, Standard and Poor's, which was established in the year 1941, and also it started work operating from New York. Now coming to India. In India, we have 5 major credit rating agencies, which are CRISIL, Credit Rating Services of India Limited, and it was established in the year 1987 in Mumbai. CARE, these two, CRISIL and CARE, both are more renowned credit rating agencies. So Credit Analysis and Research Limited, and this was established in the year 1993. Subsequent to that, India Rating and Research Private Limited, a fintech group company, was established in the year 1995 in Mumbai. Then Brickwork Rating India Private Limited was established in the year 2008 in Bangalore, and SME Rating Agency in India was established in the year 2005 in Mumbai. So these are the rating agencies who are operating in India, but mostly the rating is being done by CRISIL and CARE, what we have seen in the different news. Now, what parameters basically these credit risk agencies consider while making a credit risk assessment? Now, when they give a figure or alphabetical figure to derive that the credit worthiness of a company is good or bad, then they make certain assessments based on the industry risk, financial risk, business risk, and the management risk. So the credit risk assessment or analysis is based on these 4 parameters. They analyze the industry risk associated with the company, They analyze the business risk associated, they analyze the financial risk, all the different types of financial, quantitative financial figures, and also not only that, they are also involving themselves and looking into the overall quality of management. So they also consider the management risk. Now, when we talk about the industry risk, they while doing a undergoing a credit rating of a particular company, the uh, agency sees whether that industry is in a growth phase or in a stagnant phase of the industry life cycle. So they will assess the growth prospect of an industry, which is, if it is in a growth stage of the industry life cycle, obviously there will be a future prospect of continuous revenue which is flowing into the industry. So that is why they have to see whether the in what phase the industry is in, whether it is in a growth phase or it is in a decline stage or it is in a saturated phase. However, the CRS consider the sustainability of earnings over a period of time. So they will definitely would like to see that company's growth prospect in future, that industry's growth prospect in future, so that industry will be sustainable and that is industry can generate continuous revenue in coming years. The cyclical industries like steel, cement may not be viewed to possess very good credit worthiness. So these are cyclical industries, like they are good in a particular time period. They may not perform well in a particular time. So these type of industries, they may not be getting a good credit rating by the credit rating agencies. Whereas when we see that the FMCG sector is in a growth phase, they might be getting a better rating by these credit rating agencies, because there, when the inflow of cash is, earnings are better, continuous earnings are there for the FMCG sector, they will be in a better position to pay off their debts. Competitive intensity may be defined as the industry where there is more challenges or cost minimization, super specialization, and competition. So they will also assess how far that particular company is in a position to compete with the other competitors in the industry, how far the company is going for major technological changes which are coming in fast with the globalization, what more products or what USP the company has so that it can sustain among other competitors in the market, how the company's market, what is the company's market share, and how the customers, what is the base of customers which the company is having. That means it will also make a competitor analysis, a SWOT analysis of the company which is, for which they are going to do the credit rating. Like pharmaceutical industry, thermal and hydropower companies may have a higher regulatory risk than the other sectors. So when we talk about financial pharmaceutical industry, every time there are every at regular intervals there are policy changes, there are changes by the regulatory authority. So how far are they able to accommodate those regulation? So obviously when there is a volatility in terms of regulatory restrictions, so in that case such type of industries, they might get a lower ranking by the credit rating agency, because here the regulatory risks are more. So that means the and industry risk analysis or assessment is done initially while giving a providing a credit rating to any of the issuers. The the rating agency will also do a risk analysis of the specific company which is issuing the debt security. Now they will analyze its relative operation, scale of operation against other players in the industry, and if that particular company is in a position to compete with the other companies, obviously that company will be rated higher. Let us assume that when we are talking about IT sector, we talk about, let us say, Wipro, and Wipro, how far Wipro is having its increase in the client base, what more innovative software solutions Wipro has designed, how far it is better or having its competitive edge over the different other companies which are existing in the IT sector. So that risk or business risk assessment they will do in the terms of operation, scale of operation. Competitive position relates to the product uniqueness, business advantage, and strong brand position of the company. So these are positive factors which will give a higher credit worthiness to that company. Diversification may be in terms of geographical diversification. If a company can go geographically expand itself, it can be product diversification. Completely, the company can go for a launch of new product, or customer diversification. A diversified company can survive in difficult times, but all the while diversification is also not good in some sense. Like, a diversified company will have investment in different sectors, different other industries. So that is why it is assumed that a well diversified company have can have a better credit worthiness, because suppose if one unit does not work well at certain times, the other units will be there to back up that particular unit. But that situation is always not true also, because if a company is having highly diversified business, that means it is having more than n number of businesses, then that company will lose its own identified identity of having its own unique business. So that will again lower its credit worthiness. Operational efficiency is determined from the break-even point, capacity utilization, and contribution margin of a product. So the credit rating agencies, they will determine the break-even point by using all these factors. Automated plants, manpower, productivity, and efficient procurement of material are factors that leads to a better operational efficiency. So even they will see the operational efficiency of a business, and also they will see what is the project risk. The project risk, suppose the company is involving into a project, and for that project the company requires to raise funds by issuing of debt securities. Now the company, when it has decided to invest in that project, so how far that project is viable and how far the project is going to give returns for the sustainability of the business. So that project risk also is associated behind the credit rating. So they will also assess the project risk associated with the issuing of the debt securities. The credit rating agencies, apart from the industry risk, they will analyze the business risk. They will also analyze the financial risk. Financial risk, as we had discussed, this is in terms of the quantitative analysis or the facts and figures or the statistical data which they will be getting from the published and unpublished financial statements. The profitability ratios like return on capital employed, ROA, operating profit margin, the net profit margin determines the potential of a company to sustain and grow. They will also analyze the solvency ratios. Solvency is analyzed from the debt equity ratio, capital gearing ratio, and debt to operating profit ratio. So they will check the figures of, or they will see the trends of these solvency ratios. The interest coverage ratio, this is very much important while rating our debt security. The debt service coverage determines the ability of a company to service the debt out of its profit. How they are able to pay the debts out of the profits which are being generated. That is very much important. They will assess. Liquidity is the ability of a company to manage its short-term cash position. What is the liquid cash available with the company? The current ratio, liquidity ratio, and various activity ratios like inventory turnover ratios, the and receivable turnover ratio explains the liquidity of a company. So they will understand or analyze the liquidity of a company based on these ratios which have been reflected in the financial statements. Beyond these types of risk assessment also, the credit rating agency will be involving themselves to get some views regarding the quality of management. They will assess who are the individuals who are in position in the board, who are the decision makers, the governance of the company, and how far are they able to manage the company efficiently. A detailed study of the annual report and the interactions with officials provide a general view of the management quality, financial policies, and corporate governance of the company. So they are also analyzing the management risk by involving or discussing with the officials who are at the top level of management. Now, these are the different credit rating scales. You can see here, uh, these are the scale of Moody, the scale of S&P, and the scale of FinTech. And also they have categorized the securities into different types. Investment grade is very high. Then Moody has given A, small a 1. So these are different scales which have been, how this is being reflected by the different rating agencies. In India, CRISIL, they have a different type of rating scale. They give AAA, A1, A2, AA. These are the type of ratings which is provided by CRISIL. And they here also uh, they have categorized into long-term rating scales, short-term rating scales, structured finance rating scales. So they have categorized the different type of instruments, and after that they had given the rating. You can see here, this is the latest figure of rating, CRISIL rating. NTPC, CRISIL has given them AAA. Kotak Mahindra has also obtained AAA. So these are the ratings which have been given by CRISIL as on the specific maturity dates are given here to the different types of debt securities which have been issued by the companies. So this is just a glimpse of how they are giving their rating, the scales. Now, what are the benefits of credit rating? Now, rating given by your credit rating agencies may provide a clue to the company on the interest rate it will have to pay to its lender. A higher rate may command less interest. So, when the rating is high, obviously, rating, suppose a company is having a credit rating of AAA. So, obviously, all the investors will want to invest in that company. So when you don't have to go and search for investors, so obvious the company can give or provide less interest rate in terms of the debt security issued. A highly rated company is recognized as a valuable company in the market. Large companies having a good reputation may procure funds with ease, which may not be same for lesser known companies. Hence, for a later, credit rating is an abject necessity. Now, suppose a company is not known, it's not a highlighted company, or customers or the individuals do not know about that company. So, if for that company, credit rating becomes necessity, because if they have a good credit rating, then investors will not be hesitant in order to invest in their company. Certain debts are given only if the borrower has a credit rating score. There are agencies, or there are institutions, financial institutions, which will give the borrower the debts only when they have a good credit rating score. Credit rating provides the company with access to a broader and deeper investor base, as the former enhances its credibility through its rating. So when you have a good credit rating, the investors will obviously check the rating before investing in the debt security, and the base of investor will be more. They will have more number of investors. The management of a company decides on several factors based on credit rating, namely the timing of the debt issue, the terms, covenants of the issue, cost of borrowing, and redemption. So now the management of a issue of a company, while doing a debt issue, issuing a debt security, they will have to decide on several factors, like what should be the timing of the debt issue, what should be the cost of borrowing, and after how many years they are going to redeem that. So all the decisions are very vital, and which has an impact on the credit rating. Credit rating provides recognition, transparency, and credit standing to a company in the international capital markets. A good credit rating provides bargaining power to the lenders. The investors have higher confidence on an outside agency like CRA. They may use ratings of alternative debt instruments before taking a decision on their investments. It is not only the credit rating agency, they may also take the help of other ratings of that specific debt instruments before taking a decision whether they should invest their money in that debt security or not. Credit rating agencies interact with the management of a company intensively during the rating process. So, as we were discussing, that they are only not analyzing the industry risk, business risk, and finance risk, they are also assessing the management risk. Now, suppose there is a board which is having a strong, very good individuals or strong individuals in that group. Suppose one person resigns, then that there will be a problem, or that management risk will give a negative impact on the company's performance. So they will interact to know the management's functioning style and the quality of governance of that company before doing a rating. This discussion provides the management a very good insight of their mode of operation. So they will know what is the type of governance, what quality of governance they are doing, so that, and what are the future prospects, what sort of decisions they are going to take in future, which will be backing the sustainability of the company. Now let us very briefly discuss what are the issues which are relating to the credit rating. Now, for credit rating, there is no standard procedures for undertaking the rating process. Now, every credit rating agencies have their own parameters based on which they are doing the rating. So, it is individualistic for each CRA, and at times they may lead to inaccurate ratings. So, it is up to them, since it is not standardized. So, they are having their own parameters. There are instances of CRAs being involved in financial and corporate scandals also. Take the example of Enron, which was considered investment grade just few days before it was declared bankrupt. The issuers have the obligation to undertake the credit rating during an issue of the debt instruments. Now they will have to pay fees to the CRS for the service which they will do. So it might happen that CRS might be biased for by taking a higher fee for giving a higher rating to the companies. So that also might be a challenge. The CRS also provide various consultancy jobs beside the rating activity. An issuer may provide the opportunity for consulting to the CRA. So now, apart from the credit rating, the issuer also might give some other assignments to the CRA, and for that the CRA might give them a higher rating. The market is dominated by three big global players, as we have discussed. That is Moody, S&P, and FinTech. In India, we have only 7 recognized rating agencies. So when there are lesser number of players in the rating agency, so there it seems there might be some competition is less in the industry. So that is why there might be some inaccurate results in the rating. CRS remained largely unregulated, barring the code of conduct prescribed by SEBI, because they do not have such prescribed rules and regulation, but they have certain codes of conduct which have been given by SEBI. And as in case of merchant bankers, we have seen that SEBI has defined certain penalties in case of failure of their service, whereas in case of credit rating agencies, they do not have any sort of penalty provisions for any sort of inaccurate results or wrong assessments. So they are completely self-regulated. So these are certain issues which may arise behind the credit rating pattern of the credit rating agency. And at last, this is a figure of September 2023. India's external debt was placed at 635.3 billion US dollars, which records an increase of 6.4 billion US dollars over its level at end June. So it has grown very high, and so looking into this astronomical growth in the debt markets, so obviously the credit rating agencies have to play a bigger role for the growth of economy in future. So we will end this session here, and in the next session we will continue with the unit 7, which is on mutual funds. Thank you.